Hello, how are you? Today I will be doing the stock valuation of the Verizon Communication Inc. The ticker name is VZ. So based on that, I will try to find out whether the stock is really a buy or we can just pass from the long-term investment perspective. If I go over the agenda of this stock, it's a pretty big, heavy agenda. I'll go over the 2019 highlights. We know pretty much that this is the communication and 5G, but we'll also see what's the status as per their 10K of their 5G deployment. Is there any stock repurchase? How is the company is doing in terms of the credit ratings? Because as we know, the company credit rating is very important. If the company credit rating suffers, the interest which companies pays on the debt is higher, and there's therefore less money left for the equity shareholder, right? So it's simple as that. Okay, so we'll look into high level that, and then we look into the return on equity for the last 10 years, and actually all the models which I will go, or the margins and ratio, I am going to use the 10 years trend from 2010 to now, right? The return on investment capital, gross profit, of EBIT and net profit margins. Then we look, okay, how the company is doing in terms of the liquidity. And using the PRAT model, I'll try to see what basically drives the growth, right? So is it just the tax advantage companies having, or it's really a more leverage, or it's more on the net profit? And then I will come to use the three models. Basically, the first model is the net profit model, enterprise value model, and free cash flow model as well, right? In the PRAT model plus, I also show how the dividend yield, because it's over the last 10 years company is doing, and pretty much the company is paying the stable dividend. That's what I find. And then we'll see, okay, is this company is really a fair value at them right now, or is overvalue, and then try to make some conclusion. I know it's a very heavy agenda, but I'm very excited to go over this. So last video which I did which is on the communication, was AT&T, and I got a lot of requests in the comments that I should do the Verizon as well, and I also personally want to do Verizon. It takes me a little bit time to come, but now I'm here. Okay, so without any further delay, let's get started. If you're new to my channel, myself Pramod Kumar, I'm a CFA charter holder and FRM certified, and this is my blog. And in my channel, I does the stock valuation, right? And pretty much I go through this agenda. You can check on my channel. A couple of stocks are there, actually a lot now. And if you like it, if you're new, please subscribe and like the video. It really appreciate. Okay, let's get started without further delay. So quickly on the 2019, if I show case the highlight, let me put myself on hide so I won't by mistake hide any screen. Okay, so the dividend paid, what the company is 10 billion in dividend paid, and the operating cash flow is 35.7 billion, which is the huge numbers, right? And the dividend is increasing in 13 years in a row. So this is a pretty good. Not only the company is paying the dividend, but it's also increasing the dividend. And I also checked using the CAGR, the company, the trend personally, that the company is increasing the dividend. Okay, and the business revenue is also increasing. So this is pretty much high level. We'll go very detailed in the following slide as per my agenda. Okay, let's go. On the 5G deployment, the company is claiming in their 10K is that pretty much is you can stop and read whole, but what I want to focus here is during 2018, the company mentioned we have commercially launched 5G home on property standard in 4 US markets, and on the global standard in a 5th US market in 2019. We have also launched our 5G ultra wideband network in 31 US market in 2019, as well as several 5G compatible smartphone. So they're not only launching it, so now they are in the deployment phase. The company used the keyword as deployment. So this means it's they have the infrastructure ready, and it's already mentioned that they are deploying that, and which is very good, right? and they believe that 5G technology will provide user with the 8 capabilities or currencies, right? So more data, more usage, and I believe 5G will be the game changer as well. Okay, so let's get this to the next. One thing I also like that this is a share repurchase. The company has approved the share repurchase as of 31st December. The maximum number of share repurchase on behalf of Verizon is 100 million shares, right? And in 2000 during the year end of right now, they haven't did any purchase right now. So simply, if you just buy the shares, for sure, if the company buy back, it will increase the price, right? So that's one of the catalyst, I can say, right? It's pretty good sign as that. So this is not only companies giving from the dividend, but on the share repurchase side. So I like those companies which give the money back rather than sitting on the huge pile of cash. Okay, on the credit rating side, these are the top 3 agencies: Moody's, S&P, and Fitch. And these are the different business, right? Verizon Communication, CPN Wireless, blah blah, right? And the outlook is pretty positive and stable, and that's what it implies that. And these are the A minus, basically, and triple B, and up is the investment grade ratings. So on the communication side, they got pretty good ratings, and these are the short-term ratings. So the rating side is pretty good and stable. So not whatever is mentioned. So that's fine. Okay, now from this I'll go to the spreadsheet, and I think rather than copy and paste, I'll easy for me to go from there. So let me bring the spreadsheet. Okay, so I will go one tab at a time, and first these are the top returns. So 2 returns I am showing: the return on equity and return on investment capital. This is from 2010 to 2019, right? So each annual basis. So if you can see the return on equity right now, it's coming around 31%, which is huge, right? So before that, it even touches 1 point at 100%, and then it drops and come as, but it's huge. On the I'd like on the return on investment capital, basically this is returns happening, the capital which is deployed. So in that case, if I see this, which is in orange line, this is pretty much consistent around pretty much on the average 7, 8 or 9%. Went on to 14 as well, but the recent it's come back to 9. So the company is doing pretty good, so it's not that bad. Let's say the income statement. So these are the 3 milestones on the income statements, which is very important. First is the gross margin, which is shows in the blue line. Again, this is a 10-year data. This is the earning before income and tax, right? So before we deduct any income and tax on the operating income side, what is my earning? So if you can see that the gross margin is huge, right? It touches almost 60%, at some time even it goes over 60%, which is very, very good, right? And on the operating margin is not bad as well, which is around close to 20 or over 20%, right? So 23, here it's 24, but pretty much if I'll say is near now is over 20%. This is the line, right? This, if I take this as a line, it's right now is over. On the net profit side is over 10% consistently before 5, up from the last 5 years, 10.2. This is way huge, and then this is again pretty good. Now it's 14%. Before the first 5 year it was very down, but then in the last 5 year the company is doing a good job and it's increasing. So let's say how is the dividend payout ratio is going, because the company is paying the dividend. So here again, this is the 10-year plot, and I have put the trend line. So basically what it's trying to show is how much percentage of the income company is paying out. So the 10 years ago, the company is doing worse, right? I don't know why the company is paying 200% of its earning, and then one time it's even 5. So pretty much what it's mentioned, if if I take the first slide, which says in last 13 years the company increased the dividend, but so this means the company, the focus is to increase the dividend, doesn't matter even if they have to go and borrow the money, or right. So but in the last 5 years, and the good thing about this trend line is decreasing. So this means the company is year over years generating the income good enough that it will produce more earning than to pay it out, right? And that's why the trend line is, you can see, is going down, is dropping. So in 2017 it was very good, only 31 or 32% almost, but now is a little bit over 50%, which is okay. But in future, if they follow the trend line, it should be lower. Let's quickly check on the liquidity side. On the liquidity side, I have shown here the two ratios, the current ratios and the cash ratios, which is cash is very conservative. So basically how much liquid the marketable security or cash they have in terms to to satisfy their short-term liabilities, right? If they have to pay off anything, how much cash they have, or the current ratio basically includes more. If you don't understand this, you can search on my channel. I have very well explained how to calculate, and even one more ratio was there, right? Quick ratio bonus. But here I'm fine with these two ratios. Is not that very great, because and this means if this is a 100% is a benchmark, the cash is way down and the current ratio is pretty much not even covering the 100%. So it's shy of 100%, but maybe the company is deploying more and more cash or receiving, so that's why. But it's not that great. Let's be honest there. Okay, so let's go to the PRAT model and then to see how the company is doing overall. Okay. So if I see on the net profit margins on year over year increase, right? So this is the 10 years average. So that the profit margin is increased. If I see from 2.39% to 14.61%, right? Which is way good, huge jump. On average, the profit margin is 9.68%. So this is year over year change. Similarly, on the EBIT margin is also over its average. So this means the 30% return on equity, which I have shown, this is not only by contributed by basically is by the organic growth. So that's good. The profit margin is doing well. One thing I like to highlight here, the tax burden. So this means company is paying pretty much very less tax. If you see on the historical average, is only 11%, right, for the last 10 years effective tax rate. This year, last quarter, the 2019, they have only paid 13% taxes. So this means they retain most of their income, which is very good. On historical 10-year average is 89%. So higher is better. Think in terms of retention, right? Asset turnover ratio is pretty much is only 50%. If they can increase this, I'll really does that. But seems like this is they are not doing a good job. Company is not doing a good job in terms of using its assets to return. Maybe one of the problem here is, I'm just guessing, that in the telecommunication we can see is keep changing, right? We have 1G, then 2, and now 4G was out before, and now 5G is coming. So it's keep increasing. So I'm not sure how much the same assets they can use that. So maybe one of the reason, I'm just guessing, but anyway, so the company is using a lot of debts, so that's no doubt about it. But if I see on the historical 10-year comparison, it's reduced not only this last year, but the consistently it's been reduced, which is a very good sign. So this means now the company is not taking too much of debt. Okay, so this is the dividend. How much dividend yield we are getting on average is 4.4%. So which is good. So this means and it's in right, which is good sign. Okay, now let's go. I'll use the 3 models and then try to find out the final price. So first I'll use the net profit, enterprise value, and free cash flow. If I have seen my earlier videos where I have used this model, maybe you are more familiar, but if you're new, then I'll pretty much go on the same pace. right? To see now what's what's our intrinsic value of the stock, right? So let's go get started. Okay, again on this all three models, I'll use the 10-year of data. So this is the 10 years of revenue, 10 years of net profit, and this is the earning per share for 10 years, right? Divide by basically the net profit divided by the number of outstanding shares on each years, right? So and this is the CAGR, the year-over-year growth. So if you can see the net profit for the last 10 years, it's grown by 22.42%, which is huge increase in terms of the growth of the revenue. But in the last 5 years, it's only increased, CAGR is only 1.5%, which is less, right? And right now, the current PE of the stock is only 12.76, right? Which is, if I compare it to the industry, which is close to 30, so we can see is way down. But if I also do the normalized PE, right, basically I normalize the earning and then try to compute its PE, is even coming 19. So based on even its own normalized PE, the stock is at basically at the discount is only 12 times of its earning, right? So clearly we can see from that. But our job is to calculate the intrinsic value right now, but I just give some extra cents here as well. So I've been very conservative. So I'm not using the 10-year, although I was thinking to compute the average, but I thought let's do the conservative, because from the last 5 years, the company is only growing at the rate of 1.5%. But so I project the 10 years of net profit, and I very slowly, you can see increasing the growth rate to 2%, and for the 10 years, right, like 6 basis points and then 6 and all, right, using just the interpolation. And then I assume that I'll sell the company at the 16 times of its the last 10 years of the earning. So, and this 16 is even less than its normalized PE, right? A little bit higher, but still not bad. So just to be a little bit conservative there as well. So when I do that, I take the 10% required return, the benchmark I use for all the models. If any share doesn't even give me 10% return, I'll just simply pass. I don't care how much good or investment that it is providing, but at least I want 10% minimum return. Otherwise, just invest in S&P, right? 500. Okay, so sum this all PV divide by the number of shares outstanding. So the first model, I get my price of $62.60. Okay, let's go to the next model, which is the enterprise value model. Don't get scared by this too much of data. I'll explain how the things get calculated. So these are the first thing I calculated the market cap. Market cap is nothing but the number of share outstanding times the price, and I did that for the 10 years. I have taken the total debt from the balance sheet and the total cash from the balance sheet as well for the last 10 years. The enterprise value is nothing but just the market cap plus debt and the minus the cash. So basically what's enterprise values is, if today you have $384 billion, you can go and buy the company, right? So that's pretty much what it's saying. So this is the total value of the company. So this model helps to go there and look from the totality point of view. Okay, so this is another good. Similarly, I have taken the EBIT plus and add the depreciation and amortization into it. It's a simple sum, and then come to this one. I did enterprise value over EBITDA is 4, and then but it's keep increasing, right, to 8. But it's not bad. It's under 10. So anything under 10 is very good. So this means the company is generating enough operating income that if you buy the company, it only takes a little over 8 years to pay it off, right? So think from that perspective. On the debt side, we know the company has taken a debt, but as compared to the EBITDA is not that bad. right? Okay, so from the debt, so from the enterprise value, for the last 10 years, and we can see easily it's grown at the rate of 10, but from the last 5 years, it's on the half of it. It's pretty consistent with the net profit model. Similarly, in the EBITDA and the debt, EBITDA is quite surprisingly in the last 5 years is negative. So the company is not generating enough year-of-year operating income. But the good thing is the debt, which was almost a 10% increase, now decrease, only growing at a rate of almost 4%, which is not bad. But again, to be very conservative, I have taken the negative EBITDA growth, and then I slowly reduce the growth and then bring it to the 2%, which is the long-term economic growth for the US, I assume. Okay, so on the average, EV over EBITDA is 6, and the current right now is 8. So as compared to the historical average with this model, this is seems like it's a little bit over, but for my terminal value, I have taken the 6.2. Okay, so again, I have used the same model. I have taken the EBITDA and growing it by this growth rate, very conservative, as you can see, discounted by 10%, or just sum it together, adjust by the debt and reduce the cash, divide by number of share outstanding, and got my second model price, so which is $77.19. It's a little higher than from first model, so I got 2 out of 3. And let's say what's the third model, which is a free cash flow model. This free cash flow model, again, I've shown how I have computed, pretty much straightforward. It's operating cash flow divided by the capital expenditure, minus the capital expenditure, and then you get it. So you can see, right, and they just do the same thing for the 10 years. One thing I like to point out here, and the company is doing a pretty good job in keep investing back, right? Not only paying the dividend, but whatever the money left, keep investing. So you can see is consistently around 17 or $18 billion, right? With recent, sometimes it's 16.5, but 18. And on the operating cash flow, it's pretty consistent as well, 33 to now is a little bit over, right? So that's what I like it. If you can see on the yield basis, it's 11%, and now is 7. Pretty much on the average cash flow yield is 7%, and on the last 5 years is not bad as well, which is 6%. Okay, but the free cash flow is reduced, growth is reduced, so that's for me. I have taken the minus 1.48%, just right on the free cash flow growth rate, and then reduce it again and bring it to the 2%. On the terminal value, we can easily sell. I think this is a great company after 10 years by the multiple of 10. So that's what I have used here. I can use more, but less to be conservative, right? Okay, so which brings me to the third intrinsic value, which is the only $38 or $39, right, for this company. Okay, so now I have 3 shares. So the first one, second, and third, I gave almost equal weight to all 3, and I was very conservative in getting this price. And when this is my weighted price, if I sum it, I will get $59.27. If I go outside, the price is around $59, so pretty close to what I get it. So that's what I'm getting. So what do you think about it? So I have a couple of points to make now. Just I'll take 1 or 2 minutes. So so what do you think about this company, right? So what I think about this company is, I think the company for sure has to invest a lot. It's a telecommunication company. It's giving like a 4.4%, I think, if I'm not mistaken, in the terms of dividend. Plus, if I take the price yield, it's giving around 5%. So pretty much the overall growth is coming as a 10%, which that's why in the model give us exactly the fair value. So right now the stock is at the fair perspective as well. But the good sign is the model takes the historical the content, right, and then I plot it on the 5G. If I add the 5G perspective as well, right, so maybe the company will do much. So that's one point. But even if I take that thing out, the share buyback, the companies will be doing the share buyback, so that's another catalyst as well. So my understanding is it's not a good stock, at least to have it at least for 1 or 2 years and to see what. So for me, I own a little bit of shares of this one, not a lot, but let me know what you think about this the company. I think it's pretty is good in terms of the 5G player, and the company is consistently doing a good job as well. If you like this, kindly subscribe to the channel and like the video. Please do give the thumbs up. This way the more and more people Google will suggest and like it. And last but not the least, thanks a lot to spend a time with me and watching this video. It really motivates me when you do more subscribe, when you give a thumbs up, and if I won't ask you more, then please put a nice comments as well. And if you want me to cover any of your favorite stock which you think I should be covering, please put in the comments and I'll put in my list to make the video on that one. Thank you, and hopefully see you soon in the next video. Bye for now.